For 15 years, Portugal offered foreign retirees zero tax on their pensions. Then they killed the program overnight. For 15 years, Portugal ran Europe's most controversial tax experiment, a program called non-habitual resident, or NHR, that offered foreign retirees something almost unheard of: 0% tax on their pensions. Thousands flooded in from France, Sweden, Finland, and the United Kingdom. Lisbon's waterfront transformed. Porto's property market exploded. Portugal became the retirement capital of Europe. Then in September 2023, Prime Minister Antonio Costa stepped to a microphone and killed it. The NHR was dead, but what replaced it might be even more interesting. It's called IFICI, the tax incentive for scientific research and innovation. And it changes everything about who Portugal wants and who it doesn't. This is the story of Portugal's tax revolution. To understand IFICI, you first need to understand what it replaced. In 2009, Portugal was in crisis. The global financial meltdown had hit the country hard. GDP was shrinking, unemployment was rising, and the government needed foreign money, fast. So they created the non-habitual resident regime. The idea was simple but radical. Move to Portugal, become a tax resident, and for 10 years you would receive extraordinary tax benefits. High-value professionals, doctors, engineers, architects, academics, would pay a flat 20% income tax on Portuguese earnings, instead of the standard progressive rates that climbed as high as 48%. But the real magnet was the treatment of foreign income. Pensions from abroad, 0%. Dividends, 0. Royalties, capital gains, rental income from properties back home, all exempt from Portuguese tax. If the income was taxed in the source country, even at just 1%, Portugal wouldn't touch it. The response was immediate. French retirees led the charge. In France, pensions could be taxed at over 40%. In Portugal under NHR, 0. The math was irresistible. A French retiree with a €50,000 annual pension would save €20,000 a year in taxes simply by moving to the Algarve. Scandinavian retirees followed. Brits arrived in waves. By the mid-2010s, more than 10,000 people were registered as non-habitual residents. Entire neighborhoods in Lisbon, Chiado, Santos, Príncipe Real transformed. Property prices in the Algarve doubled. Porto's riverside became an international enclave. But the pension paradise came with a diplomatic cost. Sweden and Finland were furious. Their citizens were collecting Swedish and Finnish pensions, funded by Swedish and Finnish taxpayers, and paying zero tax on them anywhere. Both countries terminated their tax treaties with Portugal. The era of 0% pensions was over. Portugal introduced a 10% flat rate on foreign pensions in 2020. By 2023, the NHR had become politically toxic. The numbers told a devastating story. Annual tax expenditure linked to NHR exemptions had reached €1.7 billion, the highest since the program's creation. Meanwhile, ordinary Portuguese citizens were struggling. The average salary in Portugal was around €1,300 per month. Housing prices in Lisbon had climbed by more than 80% since 2015. Young Portuguese families were being priced out of their own neighborhoods by wealthy foreign retirees who paid little or no tax. The contrast was impossible to ignore. A Portuguese teacher earning €1,200 per month was paying progressive income tax up to 48%. A British retiree next door, collecting a pension twice that amount, was paying 10%, or in earlier years, nothing at all. Prime Minister Antonio Costa framed it bluntly. He called the NHR, quote, a measure of fiscal injustice, which is no longer justified, and a biased way of inflating the housing market, which has reached unsustainable prices. The timeline moved fast. In September 2023, Costa made the announcement. By October, the 2024 state budget confirmed it. No new NHR applications after January 1, 2024. But there was a transition window. Anyone who had already started the process of becoming a Portuguese tax resident in 2024 could still register under NHR, but they had to apply by March 15, 2025. After that, the door was permanently closed. For existing NHR beneficiaries, nothing changed. If you were already approved, you kept your benefits for the full 10-year period. A French retiree who registered in 2020 would continue paying 10% on their pension until 2030. But for anyone planning to move to Portugal in 2025 or later, the old playbook was gone. The question became, what replaces it? The answer surprised almost everyone. On January 1st, 2025, Portugal launched its replacement, a program with a name that tells you everything about what changed. IFICI. It stands for Incentivo Fiscal e Investigação Científica e Inovação. In English, the tax incentive for scientific research and innovation. This is not NHR with a new name. The philosophy is fundamentally different. NHR said, "Come to Portugal, bring your wealth, and we won't tax it." IFICI says, "Come to Portugal, bring your skills, and we'll reward your productivity." The shift is from passive to active, from retirees to researchers, from pension income to professional output. Portugal no longer wants people who sit on the Algarve coast collecting tax-free dividends. It wants engineers building technology companies, scientists conducting research, healthcare professionals staffing hospitals, startup founders creating jobs. The message is unmistakable. Portugal is open for business, but only if you're actually working. The eligibility requirements for IFICI are strict, and deliberately so. First, you must be a new tax resident. You cannot have been a tax resident in Portugal at any point during the previous 5 years. Second, qualifications matter. You need at minimum a bachelor's degree, EQF level 6, plus at least 3 years of verified professional experience. Alternatively, a doctorate or PhD qualifies automatically. Third, and this is the most important filter, your employer matters. You must work for a company that meets specific criteria. Export-oriented companies must generate at least 50% of their turnover from international markets. Certified startups must be younger than 10 years, have fewer than 250 employees, and demonstrate either innovation or external investment, such as venture capital. Research institutions and Portuguese universities also qualify. The eligible professions include general managers, medical doctors, IT specialists, engineers, industrial designers, and university professors. If your profession isn't on the approved list, or your employer doesn't meet the criteria, IFICI is not available to you. If you do qualify, the tax benefits are substantial. Employment and self-employment income earned in Portugal is taxed at a flat 20%. That's compared to Portugal's standard progressive rates, which start at 14.5% and climb to 48%, with an additional solidarity surcharge of up to 5% on higher incomes, pushing the effective top rate to 53%. For foreign-sourced income, IFICI offers exemptions. Dividends, royalties, and rental income from outside Portugal are tax-exempt, provided they don't come from a blacklisted jurisdiction. Capital gains on foreign assets are also exempt under the same conditions. The benefits last for 10 consecutive calendar years from the first year you become a tax resident. And the application deadline is critical. You must apply by January 15th of the year following your first year of residency. Miss that deadline, and you lose the benefit entirely. Let's put NHR and IFICI side by side. Both offered a flat 20% tax on Portuguese income. Both lasted for 10 years. Both required you to become a tax resident without having been one in the previous 5 years. But that's where the similarities end. NHR was open to anyone, retirees, investors, freelancers, remote workers, anyone with a pulse and a passport. IFICI requires a university degree, specific professional experience, and employment with a qualifying Portuguese entity. NHR's biggest benefit was the treatment of pensions. Foreign pensions were tax-free, later 10%. Under IFICI, pensions receive no special treatment at all. A retiree moving to Portugal now faces the full progressive tax rate, up to 53%. NHR didn't care who your employer was. IFICI requires your employer to be export-oriented, a certified startup, or a research institution. The filter is deliberate. Portugal looked at what NHR attracted, wealthy retirees driving up housing prices, and designed IFICI to attract the opposite, productive professionals creating economic value. So who wins under IFICI, and who loses? The clear winners are tech professionals. A software engineer earning 80,000 euros in Lisbon pays 16,000 euros in tax under IFICI. compared to roughly €30,000 under the standard rate. That's a €14,000 annual saving. Medical researchers, biotech scientists, and university professors also benefit. Portugal desperately needs these professionals, and the 20% rate makes it competitive with other European countries trying to attract the same talent. Startup founders qualify too, as long as their company meets the certification requirements. Portugal's startup ecosystem, centered around Lisbon's Web Summit connection, gets a direct boost. Digital nomads can also apply, but only if their work falls under the high-value profession list and their employer meets the qualifying criteria. A freelance graphic designer working remotely for a small agency? Probably not eligible. A senior developer working for an international tech company with a Portuguese branch? Potentially yes. The biggest losers are retirees. Under NHR, Portugal was the #1 retirement destination in Europe for tax optimization. Under IFICI, retirees receive zero special treatment. A British pensioner moving to Portugal now faces the full progressive tax rate, potentially 48% plus a solidarity surcharge. That's a dramatic reversal. Passive investors are also shut out. If your income comes from dividends, rental properties, or capital gains, and you don't have qualifying employment, IFICI offers nothing. But Portugal isn't the only option. Greece offers a flat 7% tax on foreign income for retirees and high-net-worth individuals. Italy's impatriate regime offers a 70% exemption on employment income for qualified workers. Malta and Cyprus continue to offer competitive tax programs. And Spain's Beckham law provides a flat 24% rate for qualifying new residents. The landscape is shifting across Europe. Portugal made its choice: productivity over passive wealth. Portugal's NHR is gone, but IFICI proves the country isn't done competing for international talent. It just changed who it's competing for. If this video helped you understand the shift, subscribe for more deep dives into the world's most powerful tax strategies.